Okay, if you've been keeping an eye on the markets lately, say the last few weeks, you've probably felt it. That kind of rising instability,
Hmm.
the big indices, S&P 500, the Dow, NASDAQ, they've all been, slipping.
Yeah, it definitely feels uncertain out there, like trying to steer in fog, as you
Yeah,
say.
yeah. And when things get choppy like this, just watching the daily ups and downs doesn't really give you the full picture, does it?
No, it doesn't. You need more than just where the market closed yesterday. You need a sense of the collective mood. Are traders getting nervous or are they complacent?
And that's where this one number comes in, a metric that's specifically designed to cut through that noise, give us a real-time read on, well, financial anxiety.
You're talking about the VIX index.
Precisely, the VIX. And understanding it, especially right now in October 2025, is pretty crucial for thinking about short-term risk. So, welcome to Everything You Need to Know About Finance.
Today we're diving deep into the VIX, often called the fear gauge.
And just a quick heads up before we get into the weeds, this is all about understanding the data, the history, the mechanics. It's definitely not financial advice.
Right. Just a deep dive for context.
Yeah.
And hey, if you find this kind of exploration interesting, digging into these topics, please do like and subscribe.
Yeah, it really helps us keep making these.
Absolutely.
Okay, so our mission today, unpack the VIX. What is it? What's its current level telling us, and how can you maybe use it strategically? Let's start at the beginning. What is the VIX fundamentally?
Okay, so VIX is actually the ticker symbol. It stands for the CBOE Volatility Index. That's the Chicago Board Options Exchange.
Right.
It's calculated and put out there in real time, and its main job is to measure the market's expectation of future volatility.
Expectation.
Yeah.
That's the key word, isn't it? So it's not looking back at last week's swings.
Nope.
It's looking forward. How much do traders think the S&P 500 will move over the next month?
Exactly right. The next 30 days specifically. And it gets this information from the prices of S&P 500 index options, a whole range of them. Basically, you can almost think of the VIX as the price tag on market insurance.
The price of insurance against a big market swing, probably downward.
Yeah, that's a good way to put it. When the VIX is high, that insurance is expensive because lots of people want protection. They expect more risk.
Which makes total sense why it gets called the fear index or fear gauge.
Exactly. Now, what's kind of interesting is this isn't some brand new idea. The thinking behind it goes back quite a way.
Oh, yeah.
Yeah, back to research in financial economics. Guys named Menachem Brenner and Dan Galai, this was back in 1989, they proposed something called the Sigma Index.
Sigma index, okay.
Then the CBOE worked with another researcher, Bob Whaley, in '92 to really nail down the calculation methodology a version of what we use today.
So it's got some serious academic and practical history behind it. It's been refined.
Decades of refinement, yeah, to give us the best snapshot of anxiety we have.
All right, let's make this practical. Decoding the numbers. What's the basic rule for how the VIX behaves relative to, say, the S&P 500?
The fundamental thing to grasp is the inverse relationship. It's almost a rule of thumb.
Okay.
When the VIX goes up, it means fear and expected volatility are rising, and usually stock prices are falling.
And the opposite, low VIX.
Low VIX generally means investors are feeling pretty calm, maybe even complacent, and markets tend to be stable or moving up.
But wait, you said it measures expected swings? Couldn't a high VIX technically mean the market's expected to, rocket upwards really fast? Why is it always linked to fear and falling prices?
That's a really sharp point, and it's important. Technically, VIX measures the expected magnitude, the size of the move, not the direction.
Magnitude.
Right, so high VIX just means traders are pricing in big potential moves up or down, but historically big spikes in volatility, those really sharp moves, they almost always happen when the market is falling.
Okay, so statistically, panic causes bigger, faster drops than euphoria causes rallies.
Pretty much. Fear is a more powerful, faster-acting force in markets, it seems. That's why it earned the fear gauge nickname fair and square.
Got it. So let's put some numbers on this for you listening. What are the key levels or zones people watch?
Yeah, we can break it down into rough zones based on history. Think of below 15 or maybe 15 to 20 as the calm zone. Things are pretty stable.
Okay, 15-20 is calm seas.
Then if it climbs above 20, you're entering the caution zone. Heightened awareness, maybe there are geopolitical worries or economic data looks shaky.
Like we saw during the U.S.-China trade tensions. VIX stayed above 20 quite a bit then, right?
Exactly. That's a perfect example. It signals rising uncertainty.
And then the real red alert.
That's when you break above 30. That's the storm warning or, panic zone.
30, okay.
Yeah. VIX above 30 signals extreme fear. It often means people are panic selling, expecting really wild swings. Capitulation, sometimes.
Wow. And just for context, what kind of range have we seen recently, say over the past year?
Well, looking back over the last 52 weeks gives you a sense of the extremes. The low point was down at 12.7.
1270. That's deep in the calm zone. Investor bliss, almost.
Right. And the high in that period was 60.13.
60. Okay, that puts things in perspective. That sounds like, what, early 2020 levels?
Yeah, that's reminiscent of the kind of extreme systemic fear we saw during the initial COVID shock, big crisis level fear.
Which really highlights where we are today. So let's anchor this. It's October 17th, 2025. Where is the VIX right now?
Okay, as of today, the VIX is sitting at 26.84.
2684, so clearly above 20.
Definitely in that caution zone, yeah. And what's really notable is how fast it got here. That 26.84 represents a huge recent jump over 30%.
A 30% spike in the VIX, wow.
Yeah, it tells you sentiment shifted quickly. Reflects these renewed economic worries and the volatility we've just seen.
And we can see that volatility playing out, right?
Mm-hmm.
The major indices are down today. Dow Jones made a 0.65%, S&P 500 0.63%, NASDAQ made its 0.47%. So the VIX jump isn't happening in a vacuum.
Not at all. It's reflecting real-time market stress and declines.
Okay, so we know what it is, how it works, where it is now.
Yeah.
But here's the really interesting part, the potential strategy bit. We sometimes hear traders talk about this idea. Buy when VIX hits 30. It sounds counterintuitive. Why would extreme fear be a buy signal?
It comes down to market psychology, really, and maybe saturation. When the VIX gets up to 30 or even higher, it suggests fear is absolutely maxed out.
Like peak pessimism.
Exactly. That kind of extreme fear often drives panic selling. People just want out, regardless of price. The theory is by the time VIX hits those levels, pretty much everyone who is going to panic and sell probably already has.
So the selling pressure might be exhausted. All the bad news, all the fear is already baked into the price.
That's the logic. The market has potentially priced in the worst-case scenario because emotionally the crowd has already reacted to it.
And historically, have these VIX spikes above 30 actually lined up with market bottoms?
Remarkably often, yes. Looking back, those periods of extreme VIX readings frequently coincide with significant market lows, or they happen just before a major rebound starts.
So for someone with a longer-term view, a VIX screaming panic could actually signal opportunity.
Potentially, yes. It can signal that the risk-reward balance might be shifting. If the market is deeply oversold purely because of fear, that can create attractive entry points for investors willing to step in when others are fleeing. It helps gauge that emotional turning point.
That makes the VIX incredibly powerful. It's not just measuring fear. It's potentially signaling when fear itself has gone too far.
Right. But, and this is crucial, it's a sentiment indicator, a barometer.
It tells you when the conditions might be right, but not what specifically to buy. You still need your regular analysis for that.
Absolutely. It has to be used alongside other tools, fundamental research, your own strategy. It's one piece of the puzzle.
Okay, so let's synthesize this. VIX is our go-to for short-term market anxiety based on options prices, predicting 30-day volatility magnitude, inverse relationship with stocks, key levels around 20 and 30.
And right now we're at 26.84. High, showing stress, but importantly, still below that classic panic zone of 30.
Which brings us to the final thought, the thing to mull over.
Right.
We've seen this sharp 30% spike to get us here to nearly 27. So the question for you as you're processing this is, what does this current high level mean? Is it signaling that we're about to get that final wave of panic, the push above 30 that might present that contrarian opportunity?
Or is it the alternative? Is the market just settling into a new, higher range of uncertainty? Could we stay in this 20 to 30 zone for a while, just bracing for, sustained choppiness and volatility?
That's the million-dollar question right now, isn't it? Is more panic coming?
Yeah.
Or is this the new normal for a bit?
It is. And to help you think through that and build on what we discussed today, we'd really recommend checking out some of our other deep dives.
Good idea. Like what?
Well, episodes on broader macroeconomic indicators, the stuff that actually drives the VIX ultimately. Also, our discussions on market cycles and maybe even options trading if you want to get deeper into the mechanics.
Yeah, understanding those pieces gives you much richer context for interpreting this volatility signal.
Definitely.
All right, that's our deep dive on the VIX for today. Thanks for exploring it with us.
Until next time, keep tracking that sentiment.
Keep those antennae up.